Hi there, this is Alvin from Dr. Wealth. I did a recent experiment on social media. I asked a question, which bank stock would you buy? And I didn't disclose the bank names. I only labeled them as Bank A, Bank B, and Bank C. I gave the financial ratio as shown in the picture over here. And I want you to play this game as well, right? So given this metric, let me blow this up for you. Okay, given these metrics, which bank would you actually choose? Pause the video and type your answer in the comments before I review the answer to you. Basically, they each have their pros and cons, and let's look at it in more detail. So in terms of revenue, we know that Bank B is the smallest as compared to A and C, right? Because the revenue is the lowest. And some investors may prefer to buy bigger banks rather than smaller banks. And the second thing is the average revenue growth. This is over a 5-year period on a per year growth basis. And for investors who are more into growth, would look at Bank B because the growth is the highest, almost double of Bank A and more than double when compared to Bank C. And let's say if he's a dividend investor, likely he would choose Bank C because the dividend yield is the highest at 9.4% as compared to the other two banks which are less than 5% yield. And for value investor, you will start to look at like PB ratio, PE ratio, and the lower the better, and likely he will also choose Bank C because the PB ratio and PE ratios are the lowest. And going back to the investor who prefer growth, right, it's so likely that the growth investor will prefer a bank with higher quality metrics, such as a higher ROE. So if that's the case, he will likely drop Bank C and probably pick Bank B in this case. And for capital adequacy ratio and non-performing loans, they are also indication of quality. In terms of the CAR, there's not much difference among the three banks, so there's nothing to talk about over here. But for non-performing loans, you start to see that for Bank A, the non-performing loans percentage is a lot lower, and that is a sign of higher quality. So which means that a growth investor would tend to choose A or B, while a value or dividend investor would tend to choose C. So there is no right or wrong answer when it comes to these three banks, but I just wanted to see how investors will pick without knowing the bank names, and would the bank names in the first place influence their decision. Let me review what majority have chosen. So I posted this question over several profiles and social media platforms. So this was done in the Ask Dr. Wealth group, and you can see that majority of them, 49% of them, have chosen Bank C, and 31% for Bank B, which is the second most popular, and lastly 20% for Bank A. And as for my own profile, there's a tie between Bank C and Bank B being the most popular choice. Likewise, A has been the lowest voted one. And this is in LinkedIn. 62% of them have chosen Bank C and 23% for Bank A, which is a surprise, right? Because on two previous occasions, it's actually the lowest voted ones, and then Bank B is at 15%. And on Dr. Wealth Facebook page, we have 47% who have chosen Bank C, and Bank B is the second most popular with 32% and 21% for Bank A. So you can see, regardless which platform, the consistent result that came out of it is the top choice is Bank C. So now I'm going to review which banks are this. So Bank A is actually JP Morgan, and Bank B is DBS, and Bank C is ICBC. And the reason why I chose these three is because they are the largest bank in their respective country. So most people would actually choose C, which is ICBC in this case. But I was wondering, if let's say investors know these bank names beforehand, would they still end up in the same choice? So I actually reviewed the answer and I asked the question to the social media and the respondents as well. So this were some of the comments I received, right? Once people hear China stock, all run. ICBC, the financial is one factor, political uncertainty is another factor. Perhaps that explains the higher dividend yield, higher risk, higher return. It is not considered buyer's decision to avoid Chinese stock, even if the names have been reviewed. By the way, I checked out ICBC today after the big review. ICBC is a state-owned bank. They could be asked to do national service to support the current economic situation. No, thank you very much. So although these respondents say that it is not biased, but actually it is biased against China. And that's normal, right? Because we are all human. We have bias for and bias against certain kind of stocks or even country per se. So in other words, it is true that if let's say we know the names beforehand, we will tend to ignore the financial ratios or even make a very objective decision, right? Because at the end of the day, we are very influenced by the brands, and if we find no confidence in investing in a name, it is very unlikely we will buy it anyway. So why even bother looking at the financial statements? There were other respondents as well, and they were on the opposite end. They tend to stick to their choice before even the answers were revealed, right? So quite a number of them say that, oh, they are fine buying ICBC. I don't know whether that's really the case or this is just a consistency bias, right? Because you have made a public commitment, you want to stick to it. Of course, only they will know, right? So some of them chose B and they still stick with B. Some chose C and they continue to stick with ICBC even after they know the answer. So you can see it's a mixed bag of respondents, and of course this is not really a very accurate psychological experiment or what. I was just really trying to see how investors will respond and behave. I've interacted with many investors over the years, and what I realized is this common trait. Okay, so we don't want to just make money from the stock market. We want to make money from stocks that we like. Okay, so if stocks that we don't like, even though the stock price can go up a lot and can make you a lot of money, we tend to shun them, right? Because we tend to shut them out, believe that they are one hit wonder, a fluke that is unlikely to sustain their gains, right? So that is our natural defense against stocks that are less well known. So give an example is like we know that Nvidia has been like the hottest stock this year due to the AI craze, but there's another stock called Symbotic, which I guess less people know about it. It is a logistic robot and it has been doing a lot of deals with Walmart, and the share price has been rallying very hard, and it also has some AI element applications in it as well. So Nvidia has gone up 211%, but Symbotic has gone up even more at 287%. So the fun thing is that I believe majority of people would rather buy into Nvidia and achieve a low return as compared to buying Symbotic for a higher return, simply because Nvidia is the much more well-known name. Media has been talking about it, and if you mention this to any other investor, they will know what company you're talking about. But Symbotic, I can guarantee you majority of investors have never heard of the name before. So we are very name conscious, we are very brand conscious, and it is this observation that I've made. Investors always prefer to buy a stock that they know very well. And there is a behavioral finance term for it. It's called availability bias, because it is mentioned a lot in the news, a lot by the analysts, and that's how we find comfort in owning a name. And it can even be the case that investors may not dive into the financials and they just buy the stock because the brand name is there. Okay, so that is what our biases do to us, and that will lead to more biases, right? So for example, another one is a confirmation bias. So if there is a stock that we like, we will tend to look at the good things, okay? And if there's a stock that we don't like, we tend to look at the negative things. So in this case, like for example, if let's say we dislike Symbotic, we'll start to look at, oh, it's loss making, it's not generating positive cash flow. We will start to look at all this negative aspect of it and to justify why we are not buying the stock. And if we like Nvidia, we'll talk about, oh, because AI is the next big thing, and Nvidia GPU is untouchable when it comes to AI application. So we start to look at all the rosier things and we start to project things forward. It is very unnatural that we will do the reverse, right? To look for this confirming evidence why we should not buy Nvidia and why we should buy Symbotic. Okay, so we will have this confirmation bias that will creep into us, and that's very common. And linking back to the 3 bank stocks is almost the same, right? So if let's say we know that these are ICBC stock, and people who are generally anti-China will find fault, right? Talk about, oh yeah, you need to do national service, your numbers can be trusted or not, right? So a lot of all these negative things will come out rather than the positive side of things. Okay, so that is something that we need to watch out for. And lastly, there's also another bias called the endowment effect. If we really like a brand name or a stock, we will tend to perceive the value as much higher compared to the other investors. So maybe, for Nvidia, you love it a lot, you might value it $1,000 per share, but market may see it as $600 per share. So with this, if the market continue to price at $600 or $400 or $500, not hitting your $1,000, you will always hold on to that stock, right? Because you don't feel that is the right price to sell. And it's not wrong, because it does help with building a conviction in the stock and it enables you to hold long term. But the problem comes when, let's say, the stock you love really meet into a problem that's permanent, and which means that this stock is unlikely to recover back to its glory days, and that endowment effect will cause us to hold the stock longer than we should. It would have been better off if we sell it off, right? Because of the endowment effect, we value it too much more than what the market suggests. So we refuse to cut loss, we refuse to sell. So to end it off, yes, biases generally don't make us good investors, but it is almost impossible to eliminate biases from our daily lives, not just about investing, but any parts of our life. But that doesn't mean that we just let it be. So we must be aware that we are always committing these biases, and we will want to, as much as possible, limit them, right? So for example, like what we talk about the confirmation bias, try to look for disconfirming evidence, right? If you want to buy a stock, rather than look at the good things, look at the bad things. If you can accept the bad things, the good things will naturally take care of itself. Things like this help us improve our analysis and hopefully make better investment decisions, and of course get better results. Hope you learned something from this video. Give me a thumbs up, subscribe to the channel, and we'll learn more in the next one. Goodbye.